So folks, thank you very much for coming today. This is my presentation on subject-free offers from a mortgage perspective and what you should know in terms of that. So just to start things off, who am I? Thomas Ajonki with Paragon Mortgage Group. We're one of the top 3 Verico franchises in Canada. That's one of the largest independent mortgage networks in Canada. We did about $3 billion in mortgages last year. I've been doing mortgages since 2009, initially in the capacity of the lending side, and then I became a client-facing broker after the fact. I've been doing real estate and investment and development since 1992. On a personal note, picture on the left, there's me with my wife, Lee, my son, Lucas, my daughter, Alexa, and that's our little girl, Libby, who is now 7 months old, and she's literally 4 times the weight that you see her in that photo. And the photo on the right, that's me having our sad little COVID Christmas party with Diane and Vera, who are my fulfillment agents and underwriters. Without them, I am nothing. We haven't seen each other in the flesh since February of 2020. And that's how things are with COVID. And speaking of COVID, that's kind of the thrust of today's conversation. Inexplicably, in the context of COVID, the housing market is insane. You've got what the current situation is, which is what I think is a limited supply of housing in the market in Greater Vancouver. And you've got a lot of people chasing that supply. And you see all these headlines in the media. No doubt you've heard what's going on. The phenomenon of a lot of people chasing very few properties gives rise to things like bidding wars, where you have multiple people submitting offers on one property. And one of the prevalent tactics to these bidding wars is what we call the subject-free offer, which is what I'm going to touch on today, because that's the #1 question that I, as a mortgage broker, am fielding these days in this market. Can we write a subject-free offer? Please, Toma, can we go subject-free? So first of all, what is a subject-free offer? Well, in the normal course of business in British Columbia, when you make an offer to purchase a piece of property, you quote a price, you give dates, you give terms, but you also give conditions. You say, if you accept this offer from me, please bear with me for a negotiated period of time to secure mortgage financing, like the vast majority of Canadians have to do in order to purchase a piece of real estate. Please also give me some time to inspect the property, do my due diligence on not only the property, but perhaps the complex, the strata, if it's a part of a larger complex. And let me make sure everything is kosher before I make this an unconditional offer with you. A subject-free offer is an unconditional offer to purchase. There are no strings attached. There's no subjects, no conditions, or no contingencies. It's subject to nothing. And another component of the subject-free offer is the non-refundable deposit. When you make an offer on a piece of property in BC and that offer is accepted, subject to some conditions, when those conditions are removed, only then is that deposit posted in trust as part of the purchase process. But in the case of a subject-free offer, often, if not always, the deposit is non-refundable. So what people should understand, obviously, is that when you go subject-free, there's no outs. And if you need financing, like the vast majority of Canadians do, to buy something so large, something so significant, there's a lot of pitfalls. What could go wrong? Well, a few things could go wrong. The things that a lender will consider before approving financing or not are you as the borrower, or if you want to use the nerd terminology in the mortgage world, the covenant. They'll look at the home that you're buying, which again, the nerd terminology is the security. The third thing down there on the list is, of course, if we're dealing with a larger building, is they'll look also at the strata. They'll consider not only the home, but the complex overall, and they'll consider how much you've offered. And any one or many of these things could be a reason for a lender to say, you know what? No, thank you. They're going to walk away, and because you're in a subject-free offer, unconditional, you could be stuck. So with that all being said, I'm going to unpack a few of these points here one by one, just to give you an idea as to how lenders think when it comes to approving a mortgage. First of all, they're going to look at you, the borrowers. And the first element they're going to look at is your credit. And credit is not just a credit score, it's also credit usage and credit history. So in my personal opinion, if someone's going to consider going subject free, I would want your credit score to start with a 7 or even better. The perfect credit score is 900 in our neck of the woods. But if you're not, let's just say a 720 or higher, proceed with caution. And credit score is only about 1/3 of everything being considered in terms of credit. Like I say, how many credit products do you have? How consistently have you been paying those credit products off? What's the depth and breadth of the credit that you're using as a consumer? Auto loans, lines of credit, credit cards, etc. That's what comprises a credit decision. Another important component, at least in terms of qualifying for the best, most prevalent mortgages in Canada from banks and credit unions and mortgage finance companies, is your income. Credit is important, but it all boils down to income in terms of mortgage qualification in Canada. So what I say is the most reliable form of income is a person who has had the same form of income for at least 2 tax filed years. And the most consistent, predictable form of income is the form of a salary. If you've had a base salary for at least 2 years, and by that I mean you've had the same job since at least December the 31st, 2018, so that we can see what you did in 2019 and 2020, that's a good thing. But if you've changed jobs very recently and on a probationary period, or you've got variable income, like for example, if you're an hourly worker and your hours are not guaranteed, we need to see 2 years of that in order to be able for an underwriter to use that income on a 2-year average basis. So the more predictable, and I dare say boring and reliable and verifiable your income is, the better a candidate you are in taking the risk of going on a subject-free offer. The next thing they look at is assets and liabilities. Assets is an important component in that, some lenders may make what's called a fallback decision. They may look at your investable assets, your liquid net worth, the availability of cash or investments for you to liquidate should anything ever go wrong with you from an income perspective. But the more important element of those two there is the liabilities. They're going to look at your monthly obligations, hearkening back to your credit. They're going to look at your credit card balance, your auto loans, your student loan payments, and add those to your total debt load. And if those and your housing costs that are being contemplated in this purchase are outside of their ratios, their allowable ratios, this won't fly. And if you're taking that bet, or if you're making that bet without getting pre-qualified, you could be exposing yourself. Of course, the other element being underwritten and considered is your down payment. And I say here that a down payment for a subject-free offer should be no less than 20%, so that we are in uninsurable territory. So what I'm saying here in plain English is that if you're relying on insured mortgage financing, someone who's got less than 20% down, perhaps a first-time home buyer, you're coming in with the minimum 5% or what have you, that exposes you even more. Because when we get into uninsurable mortgages, or conventional mortgages as they're known, with at least 20% down, we have the ability to seek exceptions or considerations from a lender who might look at your situations and make an exception on you as the borrower, give you a little bit more money than they otherwise would on a case-by-case basis. The other thing that you should consider as the borrower is whether or not you have enough closing costs. And the very broad stroke I use is that whatever your down payment is, that's cool. You've got to have not only that amount available, but you've got to have a 90-day history of that down payment that's verifiable and traceable. But you should also have, aside from the down payment, at least 2% of the purchase price. Well, let's just say 2% in general is a safe number for closing costs. The other thing to be mindful of is that as you're entering into this situation, you're coming to this intersection of considering making a subject-free offer. Do you foresee any changes in your world between now and the day on which the purchase of that home closes? Because if there's any changes that either are in transition or are about to happen, that could adversely affect your ability to qualify for a mortgage. So if you're about to quit your job and you're making a subject-free offer, do I need to even say it? Don't go there. Moving on, let's talk about the home itself. And a lot of what's being said on this slide is in the context of an appraisal. So value, of course, is important, and I'll touch on that with a separate slide. But the other thing that appraisals determine for a lender that I think a lot of Canadians don't even know is that appraisers give lenders an opinion of its condition given its age, and that's the REL. That stands for remaining economic life. So to use a real world hypothetical example, if you're buying an old timer house and you're going subject free and you're looking for a mortgage that has a common amortization or life of 25 to or 30 years, and an appraiser comes back and reports to the lender that this is an old timer house, and in my opinion, my professional opinion, its remaining economic life is 10 years. This house has got 10 years of legs left. The lender will walk away. And the second point there sort of is complementary to that REL argument, is that if the condition is good, if or the condition should happen to be unfavorable in the opinion of the appraiser who has the last word, a lender might say, no, thank you. This place is a little bit beat up. We're going to walk away, because you have to think like a lender. If they should ever, in the worst case scenario, have to take over this property because you've defaulted on the mortgage, they want the most marketable property they possibly can get. They don't want to have any headaches over and above the headache they've already incurred in taking over the property. The other thing that might be touched on in an appraisal is pointing out what might be any sort of structural issues that you may not have noticed during your due diligence before making a subject-free offer. Also, there may be plumbing of a certain configuration or age that is no longer favorable to a lender, aluminum wiring, K-PAC plumbing, et cetera, et cetera. And there's also a variety of red flags and wildcards that could come out of the mix. And this may or may not have anything to do with the appraisal, but it could be determined all of a sudden that this was once a grow up, a marijuana grow up that was busted and then remediated. And even if it was remediated by the book, I can think of hardly any lender that will touch a grow up property, even if it's been fully remediated, as an example. There are other wild cards like vermiculite, asbestos. If an appraiser or an inspector detects the presence of any of those materials, all bets are off. And what it's all pointing to in a roundabout way, not just in terms of its structure as is to a lender, it's also a bet on the insurability of the property by just a regular fire or home insurer. Because one thing that a lender will stipulate is that when you buy this place, you're going to have to get insurance on it. And if it's deemed to be uninsurable by an insurer and a lender cannot get themselves protected under your insurance policy, forget it. Next slide. If you're buying a home that's part of a larger project, a strata, there's a bunch of things that most lenders will check into in addition to the home itself. So if it's a condo or a townhouse, for example, they're going to look at the financial health of the strata corporation. How big is the contingency reserve fund? How have they been doing in terms of adhering to their budget in the last couple of years? They'll also get away from the financial aspect of things, and they may have an opportunity to touch on the condition of the property by looking at the historical minutes of the strata council. Those minutes may give rise to things like special assessments, and a lender will say, we see that a special assessment was levied by the corporation and everybody had to pay up a couple of years ago. Why is that? And that may be due to a couple of, again, red flags or wild cards that manifest themselves. Like, what if there is some damage to the rain screen of the building? We have a leaky condo situation. What if there's seismic damage? Anything of the sort. Of course, strata insurance is another prevalent issue these days. And one thing a lender may consider is also the status and cost and et cetera of the actual insurance for the strata corporation as well. So be mindful that while you may be reading strata minutes with a good realtor who's going to help you cover this due diligence off, while you may be okay with the status of the building, a lender may just disagree by saying, we decline this application. Another element is, of course, the value. And at the end of the day, the last word is the value and the opinion of an appraiser. So if you are making an offer that is, let's just say, over the asking price, and let's just say you get the winning offer and you are in what we might call uncharted territory, you may be in a predicament in that you've set a precedent out there in the market where an appraiser may not have enough comps, comparable sales in the market to say like, yeah, I mean, this place is worth $1 million. The client has won the bidding war, so to speak, for 1.1, but it's just so unprecedented in this particular case that I cannot support that value. Because when I refer to the next point on that slide, being the lesser of, a lender will lend on the lesser of the appraised value or the purchase price. So if you unconditionally offered to purchase a property for $1.1 million and it is set and it appraises for $1 million, are you coming up short? And the questions that you have to ask yourself when that appraisal comes through too low is, do you have more borrowing power? Can you bring up the shortfall? Or almost always is the situation, do you have enough cash to top up the shortfall over and above the limit to which the lender will lend? So with all this stuff being said, these are just a few elements. If you're making any consideration to presenting someone with a subject-free offer, and you know you have to rely on mortgage financing, if you're going to go into this if you're going to take the bet and take the dare, what do I do? And the answer to that is, do your legwork before you even consider going subject-free. And by legwork, I mean a few things. I mean, get a real mortgage pre-approval. I mean, pre-inspect and pre-appraise the property before you write the offer, because you kind of have to anyway. Read those strata documents carefully and cynically before you're even going to make an offer on a strata titled property. Ask yourself if I have a war chest, which I'll touch on. Make sure you have a backup plan in case things should happen to go pear-shaped, and also have the right team behind you. So unpacking this little list, a real pre-approval is my domain as a mortgage broker. And by that, a pre-approval is not a rate hold. And it should be clarified that that's a lot of what happens out there these days. If you talk to your lender and they tell you in a matter of 30 seconds, like you hear on TV, get pre-approved in 30 seconds, most oftentimes they're not doing any due diligence on you. They might do a soft credit check, and they'll take you at face value in terms of whatever you've put into an application. I had one client say to me that a lender representative told them in a matter of seconds how much they qualified for. And they said, how did you do that so fast in your mind? They're like, well, I just took your income and I multiplied it by 6. That's the oldest trick in the book. I do that with my initial broad stroke conversations with new clients. So it's dangerous territory to think that you're pre-approved when you're not really pre-approved. In my view, a real pre-approval involves you not only making an application and putting in your high-level information, but also providing the same documents that any lender is going to require of you in order to underwrite your application, that is, verify your information, and make a credit decision. A mortgage broker, a good mortgage broker, does this by default. And one of the jingles in the industry is no docs, no talk, which is to say, if you're not willing to be forthcoming with a mortgage broker with documentation that'll back up what you're saying in your application, there's no certainty in the reliability of your application. And so the next point on that list being confide, don't hide. I implore anyone applying for a pre-approval or an approval on a mortgage application with a mortgage broker or a bank lender, it's all in confidence, right? We have a fiduciary duty to you to hold everything in the strictest confidence. So if you feel that there's something adverse that I should know in terms of your credit history, your marital status, anything that I might point out might be an adverse element in your mortgage application, you got to tell us. You might put single, for example, in your mortgage application because you've been divorced for 9 or 10 years. But if there's just a few more spousal payments that you didn't bother mentioning because, hey, I'm single, that may adversely affect your mortgage application. That's just one example. And in the context of you going in on a subject-free offer, the question that you want to ask your mortgage broker preemptively is you want to send them the MLS listing for the property. And while you're doing your own due diligence on the property, which I'll follow here with, is you want to say, what is my borrowing and purchasing power specifically on this property? Because this is the home we want to offer on. Moving on. Pre. So I think a lot of people have probably heard about the phenomenon of the pre-offer home inspection, which I think is prudent. I would inspect the property that I'm buying regardless of the circumstances, but a lot of inspectors and a lot of listing agents are accommodating the ability for folks to get a home inspected before an offer is written, whether you're going subject free or not. And that'll allow a good inspector to bring up any potential red flags with the home with you before you actually even present an offer. Another pre that I'm pointing out here is something that's becoming a little bit more prevalent, and it may not have, it's something a little bit more recent, is what we call the pre-offer appraisal, which is that we're now seeing on behalf of mortgage brokers or lenders, we're seeing people send appraisers into the property during viewings or open houses so that an appraiser can provide an opinion with greater certainty, or I should say less uncertainty, of what the value of that home will be. And the specific question that would want to be asked of an appraiser is that, given what I think my mortgage broker thinks I could qualify to purchase this property for, the most that I could afford comfortably and responsibly, would that offer appraise given the marketplace? One little point I want to sort of digress from, but is along the same lines of the point of appraisals, is that if you're going subject free, try as hard as you can to negotiate access for an appraisal, even though you're subject free, so that either you're taking the risk of getting the property appraised after the offer is accepted, or you're providing yourself with a safety net that should one or two lenders not accept the appraisal or accept the property at all, that you have the optionality of sending another appraiser in there on behalf of another mortgage lender. We get a lot of people balking at the idea of paying for a pre-home inspection because you might not get it, or even paying for one or more pre-offer appraisals. And we say, please make the investment, because if you're wanting to make the offer that's going to be $5,000 or $50,000 over asking price, why would you not want to invest the $500 or so that would be required in securing both of these services, or each of these services? Be a strata sleuth. That is, read all the documents with a fine-tooth comb. Look at the property disclosure statement at the outset. That's going to be part of your contract of purchase and sale anyway, in a well-written contract. Also look at the Strata Form B and its appendices, which is sort of the heart of Strata documentation provided by the building's property manager, and it gives you an idea as to what's going on with the building. And comb through all of the other available Strata documentation, financials, the minutes of any regular council meetings, any annual general meetings, and more importantly, any special meetings that may have been called for things like a special assessment or anything of that nature. Ask for any available reports, such as depreciation reports, et cetera, et cetera, et cetera. And with the help of a good realtor, read those documents carefully. Make sure that you miss nothing that a lender might catch. And because if you're subject free and a lender says, we see the word leak, or we see the word water ingress in these minutes here from 4 months ago, what's this about? We don't like it, we're out. So that's Strata. The next thing to ask yourself is, what's my war chest? And like I say, if you're considering going subject free, then in my personal opinion, you should be in a position to be able to make no less than a 35% down payment. And you've either got that in the form of cash that you've accumulated, or cash from the net proceeds of the sale of one of your previous properties, or the availability of equity in another home. Also, remember what I hearkened on before, which is that over and above your down payment, have another, let's just say 2% of the purchase price set aside from the down payment for closing costs. The other part of your war chest is not only in down payment, but also your income. Let's get a responsible opinion from a mortgage broker or lender who will tell you that we'll make an offer so that you have more borrowing power on tap. We're not making an offer on a piece of property where you've not only maxed out the availability of your down payment, but you've maxed out your borrowing power, the maximum amount that you could qualify for a mortgage in purchasing this place. Leave yourself a little bit of borrowing room should there happen to be a discrepancy. Backup plan. This is over and above a war chest, just in case things go truly sideways if you are going into a subject-free situation. I want you to have conversations. First of all, family support. I want you to have a conversation with a parent or an immediate family member about not only the possibility of bumping up your down payment in an emergency situation with an additional gift, but having an eligible family member hop into the deal suddenly as a co-signer. And a good mortgage broker is going to position you accordingly so that not only have you done a true pre-approval, as I alluded to in the previous slide, but if I think there's an element of uncertainty or we're getting just a little bit tight, I may ask you to have a conversation with someone who would be a very eligible co-signer to augment your borrowing power in case we had to add someone to the deal. Another part of the backup plan is the availability of financing solutions, which is to say, if there's nothing wrong with the building or the property, but there's an unforeseen surprise with you, that means that we could rely on an alternative lender who might just get the deal done. And you have the opportunity in between the completion of the purchase and the outcome in order to solve any problems there may have been with your income, unforeseen credit issues, et cetera, et cetera. Another financing solution potentially is that if we want to increase a down payment, is to refinance a property that you already own if you haven't in fact already sold it. So with that all being said, I just want to say this for the record. Despite best efforts to manage all these risks, you as a borrower, the home, the strata, the amount you're paying and its appraised value, et cetera, et cetera, et cetera, your ability to go subject free may only ever be 100% guaranteed if you have cash. If you've got the cash to buy the property that you're considering, mazel tov, go ahead. But if you're relying on mortgage financing, I will say this for the record, I will never advise someone to go subject free on a property. I will always urge people to write an offer subject to financing because it's in your best interest and it's my fiduciary duty to keep you out of harm's way. But if you so choose to take that risk, I will do everything in my power to position you accordingly. Just to wander for a second, here's my 2 cents on the overall situation. We go back to the phenomenon of bidding wars and multiple offers and subject-free offers. You know, when you go to buy a new home, a pre-sale in this province, we have what's called the 7-day rescission period, which is to say that if you as a developer accept an offer from me to purchase one of your new homes, I have, as the purchaser, 7 days from the day that you accept my offer to back out of the deal for any reason. It can be because I cannot arrange financing. It can be because I don't like what's being said in your disclosure statements. It can be because I don't feel like it. I just changed my mind. I say what should be legislated into a purchase and sale contract in British Columbia is something like the 7-day rescission period, where everyone has a level playing field. Everyone has 7 days to do their due diligence. Everyone has 7 days to make their respective financial arrangements so that everyone's got a crack. But for now, if you're going to go subject free, that is your decision. I want to make that crystal clear. And if you're going to do it, Make your decisions surrounded by a team of experts. Find a good realtor where it's not their first rodeo in terms of being in a competitive environment. Find a good inspector who will inspect your property skeptically and alert you to any potential pitfalls. Find a good appraiser who is going to assist you in determining a value with the greatest certainty possible. A good lawyer to help you with title issues or legal advice, given the ramifications of potentially going subject free. Talk to a lawyer before you write a subject free offer. And finally, talk to a mortgage broker, because we are independent and we have a fiduciary duty to you as do realtors. And if things are going sideways and you're in a subject free offer, you want to be able to go to a person who has access to multiple lenders in one point. You don't want to go on a wild goose chase when the fit has hit the shan, so to speak. So that's everything. If you have any questions about going subject free, or if you have any questions about anything to do with mortgages, please reach out to me anytime. You've got my cell phone and my email address there at the bottom. And if you've got your smartphone handy, I want you to open up your camera on your smartphone and aim it at that little OCR grid in front of it. And it's going to open up a website on your phone. And that's the ability for you to reach out to me to schedule a call. And we can talk anytime about this or anything mortgage. I think we've gone a little bit longer than I wanted to today. And I want to thank everyone for their patience. And I see there's a few questions here, but what I'm going to do is I'm going to make a recording of this webinar, and I'm going to be circulating it. And if there are any questions, I will dig those up and I will reach out to you in due course. But for now, thanks everybody for attending. Have a great weekend, and we'll talk to you again soon.